let's welcome in Roshi Jain, the Senior Fund Manager, Equity from HDFC AMC. Roshi, if you look at the markets, it has been very volatile. In the last 1.5 months, we have seen a 3,000 points decline when it comes to the benchmark. And in the last couple of sessions or last 3 sessions, we have seen nearly 1/3 of that being recovered. How are you managing your portfolio in such kind of volatility?
I think what works for us and what works for us is that we are long-term investors and all our stock picking is based on outlooks at least over 3 years, if not longer. And therefore, near-term volatility is perhaps not as much of an issue for us. I think it is in the nature of markets to be volatile, and for anybody to expect linear movement in markets, I think is perhaps an unrealistic expectation. But having said that, I think from our perspective, given that we are more long-term investors, I think near-term volatility is not as much of an issue.
Right. Obviously, the volatility won't impact you much given the fact that you're a long-term investor, but given the 3,000 points fall that we had seen in the market, at least the benchmark, any sectors or any sectors that looked attractive post that? And if yes, which were those?
Like I said, I think near-term volatility for us is really not as much of a decision point in our sort of long-term frameworks. You're right, there has been a 3,000 point fall, but I think the context also needs to be in the perspective of what we've done in the last 12, 24, 36 months. Like I said, it is in the nature of markets to be volatile, and to assume linear journeys is perhaps unrealistic. From a sectoral or a stock-specific perspective, of course, this correction does give us the opportunity to add to positions where we already, which we hold and where we think prices have become attractive again. But I would not see this as fundamentally altering anything for us in our portfolios.
All right, Roshni. Hi, very good afternoon. This is Shrishti also joining in. Just wanted to get a sense that given the correction, one such factor was the earnings disappointment. Were you also concerned with the kind of set of numbers that we have seen in the first half of the financial year? And are you building on to the hopes on second half on the positive side? And also, Roshni, since you just mentioned that, yes, we do believe that you are a long-term investor, but given this correction, which were some of the sectors that looked attractive to you and where HDFC AMC or your fund has actually gone ahead and increased the positions rather?
So let me address the earnings issue first. I think that given India's macroeconomic situation, I do think that the earnings trajectory for the medium term for the economy as a whole, for corporate India as a whole, is perhaps, I would not use one quarter or a couple of quarters to sort of say that anything has changed meaningfully. I think we still are on the track for earnings growth to stay in the double digits over the medium term, and that being the context, I would not perhaps get overly worried over a 1 or 2 quarter disappointment, especially given that we did see government spending come off significantly in the first 2 quarters, but that's because of that was because of the elections and therefore some sort of slowdown in government spending. So I would think that the medium to long-term earnings trajectory for corporate India, I think it stays pretty robust. And in that context, like I highlighted in the previous question as well, I think that given we create portfolios more for the long term, this correction is not something that has made us sort of relook our stance. We continue to stay sort of invested in the sectors which we like from a medium to long term perspective, and tactical opportunities like this will be used to add where we already have a positive thesis, but nothing really meaningful from a portfolio perspective that has caused us to reevaluate anything given the correction that we've seen in the last couple of weeks.
All right, Roshi, let me just specifically put the spotlight on the automobile sector. What I see in that your Flexi Cap fund, that's one of the top 5 bets. Given the recent correction with respect to the passenger vehicle space, where there was indeed inventory issue, the two-wheeler stocks also corrected very much. So, Roshi, just give us a sense that how are you positioning yourself in the automobile sector, because I believe that there is interesting times ahead as we go in the next 2 to 3 months. We're going to be seeing so many of these EV launches happening, as well as rural recovery is at play. The tractor demand is expected to go up. So there is indeed some bit of a bullishness that is building in this sector. But what's your sense that what could do well from these levels?
I'm going to again change the narrative from a 3-month to a 3-year perspective. I think the auto sector in India is still fairly underpenetrated, and it is a segment where there is sort of opportunity for the market to grow. And I think it's in that context that you should also look at some of our positions in the automotive sector. There will be seasonality around festive season, inventory build-up, inventory drawdowns, year-end discounting, and so on and so forth. But I think if you just change the sort of period of time to extend beyond just a 3 or 6 month perspective, I think one thing that we've seen is that mass consumption in India, which had been sort of on a slow pace over the last few years for very many reasons, I think we should start to see a turn in that. We perhaps are already starting to see a turn in that. And I do think that the automotive sector is a very big beneficiary of a pickup in mass consumption. It's in that context of a pickup in mass consumption and huge underpenetration in the automotive sector itself in India. I think that you should look at some of our holdings. In addition, I think that we also have a very strong auto components industry, and which is globally competitive as well. And you will also find holdings in our portfolio in the auto component space, which is not just beneficiary of Indian demand picking up, but generally competitiveness in the global space, where we are seeing some softness in demand. But I think perhaps just cost competitiveness will also make market share gains another lever for growth for the globally exposed auto component sector.
Right. When it comes to your top 5 sectoral holdings, we are seeing banks as one of them. But when it comes to bank, we have been constantly seeing an underperformance coming in the market, be it because of earnings, because of the MFI issues that has been there in the market. But over a longer period of time, how are you seeing banks? And among banks, where does your preference lies? Is it the private banks or the PSU banks?
We do think that the growth of India has to be supported by the banking sector, and therefore we do think that banks are a good play on India's growth story. Again, our banking exposure is an outcome of our bottom-up stock picking. We like banks which have granular asset and liability franchise, where there are risk guardrails in place. They could be in the public sector or the private sector. I think what is important for us is the business models of those banks have to be robust. And it is in that context you will find a lot of the larger banks where the portfolio is positioned towards.
Right. You were also mentioning...
Valuations, of course, from a cycle-adjusted perspective also.
You were also mentioning that you're expecting the capital expenditure to pick up in the second half of this financial year. But given the fact that there have been a lot of populist measures that have been announced by the state and the central government, don't you see that there is a risk to this capital expenditure number that was projected in the budget?
I think again, if one takes perhaps a little bit longer term view on capex expenditure, and also going by the history that we've seen over the last few years, it does appear that this government is focused on ensuring that capex growth in the country sustains. I think also the fact that the government has done significant heavy lifting as far as capex is concerned during the immediate post-COVID years, and it's sort of unrealistic to expect the government to continue to do that heavy lifting. In fact, we've already started to see signs of private capex pickup. FY24, FY23 as well did see a pickup in private capex. So I think that from now on, perhaps the heavy lifting on capex will be done by the private sector. The government will continue to stay supportive of capex. But I do think that the phase of heavy lifting perhaps from the government is behind us, and now we will see more of the support coming from the private sector, with the government of course continuing its capex initiatives in addition to balancing various other objectives that it may have.
All right, Roshi, with this we'll let you go on that. Pleasure talking to you, and thank you so much for taking the time out and speaking with us.
If you like this video, then like, share and subscribe to ET Now.